My name is Todd Henderson. I am the co-head of our global real estate business at DWS. DWS is a global asset manager, manages about $1 trillion in assets across the active, passive, and alternative space. Real estate obviously sits within alternatives. Our alternatives business is about $125 billion in total assets. 85 billion of our alternative assets are real estate. So predominantly real estate in our alternative space, and about 75 billion of our overall alternatives business is in direct real estate invested globally in Asia, Europe, and the US. The real estate business has been an interesting place to be invested over the last couple of years. Last year was the best performance we've seen in total return for the real estate business on record. However, there was significant bifurcation in performance between the different sectors. The industrial sector was the best performing sector, with the residential sector coming in second in terms of its total performance. Both of those sectors have maintained really strong fundamentals here in the first part of 2022. However, we are clearly in a different environment in the middle of 2022 than we were at the beginning of 2022. The cost of capital is changing, and the market is in transition as a result. The expectation for an economic slowdown is a high probability, and therefore that's factoring into investment decisions today as well as in 2023. So in order to outperform going forward, we think you need to invest across the more defensive sectors in the face of what has currently occurred. And what does that mean? Well, it first means that the sectors that have the highest probability for rent growth will cushion the downturn in values as a result of the increased cost of capital. The sectors that have performed best in the face of that to date have been the industrial and residential sectors. Again, low vacancies and strong demand through the first half of the year. We expect that the industrial sector and the residential sector will continue to be the best performing sectors. We do not expect that we will see the type of performance we saw in 2022 or in 2021, or even in the first half of 2022. We expect that to moderate. However, we do expect some of the secular shifts in demand that have supported demand in industrial to continue. E-commerce, onshoring, inventory rebuilding, inventory security, those things will continue to drive demand here in the US for industrial real estate. We expect that on the residential side, the fact that we are underserved in terms of residential housing in the US, there is a shortage of residential housing, both for rent and for sale. For sale has become materially more expensive, with mortgage rates going from the mid 2s to the high 6s over the last 12 months. We expect, and we've seen a slowdown in the delivery of new for sale homes. And the cost of those homes have not come down materially, in spite of the fact that mortgage rates are expensive. So that to me translates into more demand for residential housing. And then if you look at residential housing's performance, typically through a downturn, people pay their rent. So collections are generally pretty strong through downturns. And we also typically see residential be one of the best, if not the best performer coming out of a downturn. So we believe that the industrial sector and the residential sector both are two places to be. They're defensive, they have high income typically, and they have low capital expenditures. And in an environment where the market is dislocated or changing, you want security of income and low capex to ensure that that income is stable, and in order to support total return through a change in capital markets for the pricing of real estate. So continuing with a discussion of the different sectors, let's talk about the retail sector for a moment. Retail suffered early on in the pandemic. However, certain parts of the retail sector have made a very strong comeback over the last 12 months. In particular, the grocery-anchored necessity retail sector has performed very strongly over the last 12 months. We've seen some of the highest rents and lowest vacancies that we've seen on record in the sector. There were more new retail companies than bankruptcies over the last 12 months. This is a real positive sign for the sector. Now, there are other parts of the retail sector that aren't as defensive. We like the grocery-anchored necessity retail sector for a number of reasons, but in particular, the reason we like it is it's very hard to disintermediate through e-commerce. Those cash flows from service-oriented tenants are fairly predictable in the face of e-commerce competition. And as a result, in particular, as the economy has moved from a buying of goods online to a buying of services economy, we've seen restaurants, we've seen service-oriented type tenants that are in these retail centers perform well. Again, that demand is likely to moderate as an economy slows, but we still think that the retail sector is a defensive place to be, in particular in these grocery-anchored, service-oriented type centers. The biggest challenge that we see in the coming months is the office sector. Office has a high correlation to the business cycle. And as we mentioned at the outset, we are expecting to see a slowing, if not a recession, in 2023. So the office sector, before we even add the impacts of work from home to demand, the office sector is really faces a number of challenges. In addition, today, there's very little liquidity for the office sector. There's very little financing, and without financing, there is not a lot of equity as well for the office sector. So both from a fundamental perspective, as well from a capital markets perspective, the office market is the most challenged, and I think it will continue to be challenged throughout 2023. The investors today are interested in durability of income and the diversification of income. Investors have historically chosen the real estate space for income and diversification. And over the first half of the year and over the last, let's say 3 quarters, the real estate markets have done exactly that. They have been diversified. They've provided much better returns than the fixed income markets and then the equity markets. In fact, what they have provided is such good returns that many investors today are at their stated weights for real estate or even overweight to real estate. But they continue to want out of real estate diversification and income. And in a market like we're in now that is transitioning, they want durability of that income. They want safety of that income. And so they are looking again into the sectors that are providing them the most defensive income and potential for growth in the broader market. And we believe, again, that is the industrial and the residential sectors. The real estate market is in a state of transition in terms of pricing. That's a risk. The continued increase in interest rates has changed the cost of capital. Certain sectors have been more affected by that. Sectors that rely more on financing are going to be more impacted than those sectors that rely more on cash deals and less financing. However, the entire market is being impacted by the increase in rates. And I think we have to continue to watch rates because that in effect determines the cost of capital, and the determination of cost of capital will have an impact on how materially the real estate market reprices over the next couple of quarters. The second risk, the second derivative, if you will, of significant increase in rates that we've seen from the Fed is the challenge of a soft landing and the Fed overdoing the interest rate increases that pushes the economy over into recession. And I think investors have to be aware of the fact that the risk of recession has increased. And with the risk of recession comes the risk of demand deterioration. I think the sectors that we've talked about, the residential sector and the industrial sector, are coming off of such strong fundamentals, historically low vacancies, that a deterioration in demand will only put us back to vacancies that are more in line with historical standards. So there's more of a normalization, if you will, in terms of occupancy levels, and those two sectors will remain pretty healthy. But I think investors need to be able to evaluate the risk of new supply, the risk of demand deterioration, and what that means for each one of the sectors that they invest in here in 2023 as the investment market becomes more challenging to navigate. I think investors need to make a determination as to how much risk they want to take in the real estate markets today. One area outside of real estate equity, which we think is a good opportunity, is real estate debt. Lending into this market at the moment is pretty attractive. Rates are as high as they've been in decades. Attachment points or loan to values are much lower as a result of debt yields being so significantly higher. Underwriting typically in time periods like this becomes, frankly, better because it's more conservative in terms of underwriting. So when you have, and spreads typically become wider. So we have higher base rates, higher spreads, lower attachment points, and better underwriting. That's a formula for some really quality risk-adjusted returns in our view. And so we're constructive on the debt space. Certain sectors we would be even more constructive on, and we've talked about those sectors, the residential and the industrial sector. That extends to the debt business as well. I think that there are going to be some fantastic opportunities in late 2023 as we get on the backside of the repricing that's happening as a result of the cost of capital. I also think that there's some really interesting opportunities that will come off of the backside of an economic slowdown. So I'm actually really optimistic about the latter half of 2023. And if you're looking to take a little bit more risk in your real estate portfolios, building capital today to be prepared for the opportunity that will exist as the Fed slows down their tightening, as the market absorbs the Fed's aggressive stance against inflation, and as the market absorbs what's likely to be some demand deterioration as a result of the Fed potentially overdoing it. I think building capital now for the opportunity that exists on the backside of the environment we're in now is a really prudent thing to do, and will generate, we think, above market or above historic returns for the real estate sector. Thanks for participating with us today. And if you'd like to learn more on our views in the real estate market, please visit our website.